Let me ask you something real quick. When you bought your last car, what number were you focused on? I'm guessing it was the monthly payment. Maybe it was $450 a month. Maybe $550. Maybe you stretched it to $600 because the car was just too good to pass up. Here's the thing nobody tells you when you're sitting in that finance office signing page after page of paperwork. The monthly payment is the single most dangerous number in that entire dealership. Not the sticker price, not the interest rate, not the fees. The monthly payment. Because when you're focused on $550 a month, the dealer can charge you almost anything else and you'll never notice. And millions of Americans are finding this out the hard way. Right now, the average monthly new car payment in the United States has hit a record $767. $767 every month for a car. That's more than many Americans pay for rent. And today, I'm going to show you exactly how it got this bad, and more importantly, how to make sure it never happens to you. I want you to meet Marcus. 32 years old, warehouse supervisor in Phoenix, Arizona. Makes about $52,000 a year. Decent money, lives within his means, pays his bills on time. 2 years ago, Marcus needed a new car. His old Honda finally gave out at 180,000 miles. He did his research, or at least he thought he did. He went to the dealership knowing the car he wanted, a 2023 Toyota Camry. He looked it up online. The MSRP was $28,400. He walked in, talked to the salesperson, negotiated hard, actually got them down $1,200 from sticker price. He was proud of himself. Then he went into the finance office. The finance manager was friendly, offered him coffee, made small talk, then said those 5 words that cost Marcus thousands of dollars. What monthly payment works for you? Marcus said $500 a month, maybe $520 if I have to. And just like that, the finance manager had everything he needed. Marcus drove home in his Camry that day thinking he'd won. He hadn't. Here's what happened in that finance office that Marcus didn't see. The moment you say a monthly payment number, the dealer stops thinking about the price of the car. He starts working backwards from your payment. If you can afford $520 a month and they stretch the loan to 72 months, that's $37,440 over the life of the loan. For a car that costs $27,200, that's $10,240 in interest on a Toyota Camry. But wait, Marcus also got hit with the dealer reserve. Here's what that is. When you finance through a dealership, they don't give you the lender's real interest rate. The lender might approve Marcus at 5.9%, but the dealer tells Marcus his rate is 7.4%. That 1.5% difference, the dealer pockets it every single month for the entire life of the loan. The FTC calls this dealer reserve. It's completely legal, and it costs American car buyers billions of dollars every single year. Marcus's actual rate should have been 5.9%. He got 7.4%. On a $27,000 loan over 72 months, that difference cost him an extra $1,800 on top of the $10,240 in interest, on top of the $800 in dealer add-ons he barely noticed, like the paint protection package and the tire warranty and the gap insurance at twice the market rate. Total extra cost? Marcus overpaid by just over $5,000 on what he thought was a smart car purchase. Now, let me zoom out and show you what this looks like at a national level, because Marcus isn't alone. Right now, Americans owe $1.53 trillion in auto loan debt. Let that number sit for a second. $1.53 trillion. The average auto loan balance is $24,297. The average new car transaction price crossed $50,000 for the first time ever in 2025, up more than 30% from 2020. And here's the part that should genuinely bother you. Loans spanning 84 months, that's 7 years, are now becoming common. Some buyers are taking 96-month loans, that's 8 years on a car. A car that will depreciate 60% in value by the time the loan is paid off. Think about that. Month 72 of your 84-month loan, you still owe $8,000 on a car that's now worth $6,500. You're underwater. You can't sell it, you can't trade it in without rolling that negative equity into your next loan. And then the cycle starts again. This is not an accident. This is a system designed to keep you making payments forever. I want to break down the 84-month loan because this is where the real damage happens. Let's say you buy a car for $35,000, 7% interest rate, 84-month loan. Your monthly payment looks reasonable, $531. Sounds fine, right? Over those 84 months, you'll pay $9,604 in interest. But here's the part nobody calculates. That car loses about 15 to 20% of its value the moment you drive it off the lot. By year 3, it's worth maybe $22,000. By year 5, maybe $16,000. By year 7, $10,000 to $12,000. You're making $531 payments on something worth $12,000. And remember, dealers love long loans because a longer loan means more months of dealer reserve interest, more time for the loan to generate profit. The monthly payment looks small, the total cost is enormous. One more stat before I show you the fix. A buyer who negotiates $1,500 off the sticker price and then accepts a financing rate just 1.5 percentage points above the real rate will often pay back more than they saved from negotiating. Think about that. You spent 2 hours negotiating the price, they took it back in 4 minutes by adjusting your interest rate. Okay, here's how you protect yourself. 3 rules, non-negotiable. Rule number 1, never, and I mean never, tell the dealer your monthly payment number. When they ask what monthly payment works for you, say this exact sentence: I'm focused on the out-the-door price, not the monthly payment. That one sentence shifts the entire negotiation. They can no longer hide costs in the loan structure. Rule number 2, get pre-approved at your bank or credit union before you step foot in any dealership. Walk in with a pre-approval letter at 5.9% from your bank. Now the dealer either beats that rate or you use your bank. The dealer reserve game is over. You've already won the financing battle before it started. Rule number 3, never go above 48 months on a car loan. Maximum. If you can't afford a car on a 48-month loan, you can't afford that car. Go used, go cheaper, go smaller. A car is not an investment. A car is a tool, and the cheapest tool that gets you to work is almost always the right tool. Marcus, by the way, figured it out. After 2 years of payments, he sat down and ran the real numbers. He calculated that between the inflated interest rate, the add-ons, and the extended term, he'd overpaid by over $5,000 on a car he thought he'd negotiated well. He's not buying another car without a pre-approval letter and an out-the-door price in writing. If you're in a car loan right now, check your interest rate. Then check what your bank is currently offering. If there's more than 1% difference, you might be able to refinance and save hundreds of dollars a month. Just takes one phone call. Share this with someone who's about to buy a car, or someone who already did and has been wondering why the payments feel so heavy. They need to hear this. And next week, I'm going to show you the subscription trap. The average American is paying $219 a month for subscriptions they forgot they signed up for. That's $2,628 a year, quietly leaving your bank account every single month. Subscribe so you don't miss it.